things moving. So thanks very much for joining us. Relax in your seat, go and get yourself a drink. Well, let's get going. Thanks very much for joining us for the 8th Henry Halloran Lecture. My name's Peter Phibbs. I'm the director of the Halloran Trust, and I'll be your moderator tonight. It's going to be a great night. We've got Ian Mulheirn waiting in the wings, who's going to present our annual lecture. But before we begin proceedings, I'd just like to acknowledge and pay respects to the traditional owners of the land which we are meeting on, and that is the Gadigal people of the Eora Nation. It's upon the ancestral lands that the University of Sydney is built. And as we share our knowledge, teaching, learning and research practices within this university, may we also pay respect to the knowledge embedded forever within the Aboriginal custodianship of the country. And as we've been doing right through the festival, if you'd like to put into the chat the Aboriginal land that you're on, that would be excellent. Now, before we get started on the lecture, I just wanted to do a few things. And first is to acknowledge Warren Halloran AM, the philanthropist who donated $10 million to the University of Sydney to establish the Henry Halloran Trust. The trust was named in honour of his father, Henry Halloran, who was a leading Australian developer and an early advocate for town planning in Australia. Very sad that Warren passed away in January this year. Now, what we've done is we've asked John Toon, who's a member of the advisory board of the trust, but also a town planner who worked for Warren for many years, to tell us a little bit about Warren and the history of the trust. So we've got a short film that we're just going to roll now.
He was a mine of information. I mean, his knowledge of the history of Australian urbanism and land development was really quite significant. He knew about all the explorers. He knew very much about the South Coast and all the various people that opened up areas of the South Coast. He did go into the history of Australia, and European Australia particularly, more so than, say, the future. So he wasn't necessarily a futurist. His passion for Australia was very great, and I think he must have got that from his father. And it was always a joy to work with him and to talk with him and to discuss Australian history, actually. And I learned a lot from him. He might have learned quite a lot from me too, because it's an area that I've always been interested in. Once you got to know him, he was a lovely man. He was very gentle, not really your typical real estate person at all. He was quite different to that. There was a lot behind the man, but he wasn't social, garrulous, or anything like that. He was rather retiring, yes. But nevertheless, he was still a lovely man. Well, I mean, the truth of the matter is that I had spoken to him many times over probably the last 20 years about giving some money to the university. But my theme was to establish a chair in honour of his father and name it for his father. And he sort of said, well, yes, we'll talk about that some other time. We'll talk about. So he kept on pushing me off and pushing me off. And then as he got older and obviously was aging a bit and needed to tidy up his affairs, I think, and so on. And he obviously must have talked about it with his accountant, Peter Scott. And he invited me to come down to the office and talk. And I said, well, that's interesting. We've talked before, you know. So we go down and have a chat. And he said, well, he says about this university thing. And of course, he didn't really go to the university. He wasn't really a university person. And so I said, oh, yes, well, what I'd really like to see is this and this and this, you see. And so he said, well, maybe he said, well, and then the accountant said, well, how much do you want, you see? And I thought, oh, well, for a chair, it's about 3 million or 4 million in those days. And So he said, the counter said, well, that's not enough, is it? You can't do anything with that. He said, wouldn't you need 10 million or 15 or 20 million? Well, I said, you certainly would, because I was totally taken aback.
So thanks, John. So look, what we'd like to do tonight in honour of Warren is to rename our annual lecture series from the Henry Halloran Lecture to the Halloran Lecture, so we can acknowledge both Warren and his father Henry in the name of the lecture. So as of tonight, we are now listening to the 8th annual Halloran Lecture that Ian will present shortly. Now, before we get onto the lecture, and we'll get there very quickly, I just want to take this opportunity to present 2 awards. Now, these are the awards are the inaugural Festival of Urbanism Distinguished Urbanist Awards. Now, the first award is the Chairperson's Award. The chair of the trust is Professor Tong Wu, and he's presenting this award on behalf of the advisory board of the trust. So the first ever Festival of Urbanism Distinguished Urbanist Award goes to John Toon, who you've just heard from. Now, the commendation for John reads, we want to show our gratitude and appreciation to Professor John Toon to recognise his fundamental and singular initiative in securing funding for the Henry Halloran Trust, for guiding its inception with the help of Mary Lynn Taylor and Martin Payne, and for his unstinting and continuing efforts to help the Trust grow and develop. Without John's efforts, we wouldn't be here tonight celebrating our 8th Halloran Lecture. So thanks very much, John, and your award will be heading your way shortly. Now, the second award, the second and final award, is the Director's Award, and that's me, so I get to make this award. And this award, the second Festival of Urbanism Distinguished Urbanist Award, goes to the person that was the co-director with me for the first ever Festival of Urbanism, and that's Dr. Rod Simpson. Now, Rod's commendation reads, for his passion, energy and ideas over many years as a consultant, architect, urban designer, educator, policy advisor, activist, federal urbanism director, and most recently, Sustainability Commissioner, all directed at making better places. His work has impacted so many people across our cities in a positive and enduring way. So congratulations, Rod, and your award will also be in the mail shortly. So look, let's return to the main business tonight, and that is to hear Ian Mulheirn deliver the 8th annual Halloran Lecture. Now, the title of the lecture is How to Fix Housing Affordability in Our Cities. Is housing supply the big answer? Is the main issue at night, and Ian's going to talk about the situation in the UK with some references to Australia. Now let me introduce Ian. Ian is the Executive Director and Chief Economist of Renewing the Centre at the Tony Blair Institute in London. He was previously Director of Consulting at Oxford Economics, a global economic consulting company. And before that, directed the Social Market Foundation, a Westminster public policy think tank specialising in economic research and policy design. Prior to that, Ian was an economist at the UK Treasury, and he's also chair of the board for Generation Rent UK, which is a voluntary role. So very much looking forward to hearing what you've got to say tonight, Ian, and thanks very much for getting up early in London to join us. And we're really interested to hear what you've got to say tonight. If you can just unmute yourself and show your camera, we'll get the ball rolling.
Thanks very much, Peter. It's great to be here, and it's a real honour to be asked to give the 8th Halloran Lecture. So thank you very much. I'm sorry not to be with you in person this year. Inevitably, coronavirus has put a stop to that. Instead, as you say, I've had to get up a bit early on a cold winter's day. I know in Australia you're enjoying something a bit more pleasant out there. And these being kind of COVID times, instead of speaking to you from a lecture theatre, I'm coming to you from my daughter's bedroom. And the irony wasn't lost on her that I was kicking her out a little bit early to talk about how there wasn't a shortage of housing this morning. So, so there we go. Now, as you sort of mentioned, Peter, my talk will mainly focus on the role of supply in the housing crisis, it's based on reflections that and a paper I wrote last year for the UK Centre for Collaborative Housing Evidence here in the UK. And it's very much UK focused, most of the analysis that I'm going to present, although I tried to draw some links out to the Australian context. But I think the key point is, and the reason why I think you asked me to speak, is that really the story is one of how the housing crises and most of the housing problems that we've faced in various countries around the world at the moment are not the kind of caused by the parochial concerns, local concerns that people often attribute them to. Instead, there's a bigger global story going on, and that's why I hope the story as I see it from the UK, I think is fairly relevant to the Australian story. And when we get into discussion later, I'm sure we can bring some of that out. So let me just pull up my slides and get cracking. So yeah, the title I've got here is Housing Supply. Is supply the solution to the housing crisis? Well, first of all, what do we mean by the housing crisis? How we define it? And obviously, everybody has lots of different definitions, and I'll come on to some more angles on the housing crisis shortly. But I guess the most obvious one is represented by this chart for the UK, at least. This is average house prices in the UK in real terms, so adjusted for inflation, going back since the late 90s there, and you can see that you've got this 160% increase in house prices in real terms over that period. Most of it in the run-up to the financial crisis, but then recent rises still, and it's gone a little bit further up since this chart ended. But as I say, there's lots of different aspects to it, although that may be the dominant perception of what the housing crisis is. We've also got other things that people point to here, at least. We've got.
Sorry to interrupt, Ian. We just can't see your slides at the moment. Just in the share screen.
Oh, I have not shared screen. How is that?
That's it. Excellent.
Okay,
thank you.
Good. Sorry about that. Right. Okay. Right. So the chart I was just talking about there is the house price chart you can see there. But as I say, there's lots of different aspects to what people talk about as the UK housing crisis. You've got things ranging from unaffordable rent costs to rising levels of homelessness. Falling home ownership often features as a key symptom of the housing crisis, and of course that chart, the unaffordable house prices picture as well. And of course, what do people put it down to? Well, mostly in the UK, all these symptoms tend to be attributed to one single cause: a lack of housing supply over the years. And we see this echoed in government papers. So here I've got an old quote from the UK government's housing white paper back in 2017, and a quote from the New South Wales Productivity Commission Green Paper, which came out a few days ago. Both of them very clear and definitive that there's been an undersupply of housing, that housing has not kept up with demand, and that is the cause of high prices effectively. So you see this a lot. All sorts of policymakers make this argument and state it very definitively. So I'm always put in mind of this possibly apocryphal Mark Twain quote that it ain't what you don't know that gets you into trouble, is what you know for sure that just ain't so. And that is the focus of what I'm going to talk through. So I'll talk about whether there have been decades of undersupply in the UK. I'll talk about how I think we should be thinking about housing and the housing market, and which price signals we should be looking at to find out what. Then I'll talk about what has been driving house prices and whether supply could help. How much could it help? Because it could help a bit. And then I'll briefly talk in the final section about collapsing home ownership, and that is more of an issue in the UK than it is in Australia. But it's still, I think, instructive as to how the whole picture fits together. And then I'll leave you with some concluding thoughts. Okay, so decades of undersupply. This is the claim. It's a very common claim that we hear all over the place. And one of the most common errors, certainly in the UK debate, is that there's a focus very much on a new build completions rather than net additions to the housing stock. And what you get is, when you look at net additions, this is kind of new dwellings produced or created, less demolitions. You get this relatively steady, fluctuating up and down with booms and busts. But you get relatively steady addition of dwellings to the housing stock over the years, going back to the 70s. But what people often point to is they point to the new build picture, which is obviously a gross figure, and it's only one part of the additions. And what you see there is this quite alarming reduction from over 300, coming on for 300, 350, almost 400 in the late 60s, 1,000 houses a year being built. And that has dwindled away, and is now, tends to be below 200,000. And this, lots of commentators point to this, and they say, well, you see this line going down, you see the price line going up, QED, the two must be related. But when you look at this dark blue line, you actually look at the number of units being produced each year. That story loses some of its power. And then, if we think about the argument for a housing shortage, one of the most puzzling things I find in the UK debate is that rarely does anybody actually try to just put together the basic numbers on, well, how many dwellings are there and how many households are there in the UK, and how have those two numbers been changing over time. And so that's what this chart tries to do. It has the number of houses divided by the number of households expressed as a percentage here. So 100 would mean there's one house for every household in the country. And obviously it's above 100, so there is a surplus stock of housing. There are some unoccupied houses. And what we see when we do this, based on census numbers and counts of the housing stock in the UK, so this is the best read we have on what the actual situation is. What you can see is that for going back to the 70s, this surplus stock of housing has been steadily growing over time, and particularly since we've got sort of more regular data from the early 90s, it's been trending steadily upwards despite some booms and busts. And in England, that surplus was 660,000 dwellings in 1996, but by the last available year we've got reliable data for it, it's grown to be 1.23 million in 2019. So this is not proof that there's no shortage of housing, but it is a picture that you don't often see, and it makes it rather difficult to argue that we obviously we haven't built enough homes. One of the arguments that people often make is, well, maybe we've been building all these houses or adding all these houses in the wrong parts of the country, and perhaps it's that nobody's been building any houses in London, for example, where pressures on demand have been greatest and the price rises have outstripped the rest of the country substantially. But when we look at a regional level, that doesn't appear to be the case. So in this chart, we've got the change in the number of households over the period here from 2001 to 2017. The change in the number of households along the y-axis up the side, and the change in the stock, proportionate change in the stock along the x-axis. So essentially, the 45-degree line determines whether or not, if you're above it, we've built houses slower than the number of households that have formed, and the surplus is shrinking. And if you're below it, then the surplus has been growing. And when we look at all the regions, certainly of England, what we see is this picture. So kind of as I showed you before, the England story follows the UK pretty much. Surplus stock has appeared there. But even in London and the southeast here, we've got some pretty clear evidence that the stock has been growing faster than the change in number of households. So it's pretty hard to argue that the stock has been built in the wrong places over the last 20 years or so. So it doesn't seem like a very compelling argument for what's behind price rises. And thanks to Cameron Murray here from his paper earlier this year, we can see a similar kind of story for Australia. And what you've got again here, we've got a slightly different measure. We've got the number of dwellings per 1,000 people. And what you can see there again is a pretty steadily upward trending line with a break after the financial crisis, leading to a bigger surplus of dwellings now than there has been at any point going back to that late 90s period. So a pretty similar picture. Again, none of this on its own suggests that there's enough housing or that there's no shortage, but it does make it, these are figures you don't tend to see from people suggesting there is a shortage, and that's because it's rather difficult to square this with the idea that there isn't enough housing in either Australia or the UK. Okay, but for economists, obviously, talking about volumes is not, kind of as I was hinting at there, is not really the full story. We want to look at prices. We want to see what's been happening to prices, and particularly affordability, and that should tell us more about whether there's been sufficient housing supply over the years. And so focusing on the price, not the quantity. And of course, one of the reasons why that's important is that households only form if they can afford to do so. There's household formation in the jargon is endogenous to supply. If housing costs are rising faster than incomes, then household formation will inevitably slow. And therefore, we want to see really what's been happening to affordability, and has it been declining in such a way that it might have caused household formation to be constrained. And for that, we really need to think in terms of two different types of prices, because really the housing market, and I think this goes to a lot of misconceptions about housing, the housing market is not one market in the sense of there being one price for it. And I don't mean about geographic differences here. I mean that there's really two things that a house provides. One is it provides a stream of services, a place to live, shelter for people, and the second is that it provides an asset which can supply those things. And there are two different prices for those two different different aspects of what a house is. So if there's a shortage of housing or housing services and places to live, we would expect the day-to-day rental price, that is the cost of housing services, to be rising faster than incomes. Now, for the UK, so how do we measure this cost of housing? How do we get a handle on what the day-to-day cost of housing is rather than the cost of the asset of buying the house? Well, the way most statistical agencies around the world do it is that they have some kind of index of private rents. In the UK, it's called the Index of Private Housing Rental Prices. And it aims to track houses on a like-for-like basis over time. What is the rent that they go for in the open market? And that tells you something about, and via the concept of rental equivalence, they can work out effectively what the sort of implied cost is for homeowners who aren't paying any rent. If they were to rent the house they lived in, what would be the cost they would be paying? Because that's essentially their foregone income. That is the cost they faced from not letting the property that they are living in. So we can use rental prices, as I say, to be that indicator of what's happening to the affordability of housing. And over recent years, we can look at, so that grey line there is the IPHRP. That's the rent index in the UK over the years since 2005. In fact, I think this is for England. And we can compare that to various measures here of median household income. And you can see that in all of them, and the trend has continued since in the last data point, in all of them, what we've seen is median incomes very much comfortably outstripping the rise in market housing costs over that period. Now, again, that doesn't really suggest that we've faced a housing shortage. And again, we can do the same exercise as before, looking at changing housing costs, those rental costs on the y-axis, and median household income by English region over the period here. And again, you can see that almost all regions are comfortably in the increasing affordability zone. But of course, perhaps not surprisingly, given the focus on it here, particularly London is sort of on the boundary. So we can't say that supply has been making things more affordable necessarily in London, but it hasn't been getting worse either. And in other parts of the UK, it seems pretty clear that affordability has been improving over that period. And we can also take it further back. While we don't have hugely reliable data for it, it's possible through a number of methods to backcast and piece together what's happened to rents further back into the 90s, so that we can see, how the picture compares to that price line. That's that house price line again, and that's mean household income, and then we can look at that rent series spliced together, going back into the mid-90s. And what you can see then is that housing costs, the day-to-day cost of housing then, in the dark blue line at the bottom, has been very flat and has lagged household income growth. Meanwhile, prices have massively diverged and exploded. That, in other words, the price of housing services and the price of housing assets has substantially diverged over the past 25 years. And of course, we get a similar story in lots of other parts of the world, but particularly in some of the major cities around the world. And here, this is a chart, I think, from Cameron's paper, which shows a very similar story over the past 10 years for Sydney and Melbourne, with rents essentially just bumping along, but this explosion of prices as it diverges away from the cost, the day-to-day cost of housing. So what does all that mean, and what has been driving prices? If the day-to-day housing cost hasn't been increasing, then something else must have been behind that increase. I won't labour the economic theory on this, but essentially what we see in the economic theory is that rent is supposed to equilibrate that demand for housing services with the flow of them from a given housing asset. So what you find is that the price of, or the cost of owning a property that's priced Q is a function of the user cost, this omega figure here. And omega is a function of several different components: the depreciation rate, so that's the cost of maintaining the property, the mortgage interest rate, the opportunity cost of housing equity, i.e. what you could have got for that housing equity if you'd invested it somewhere else, and expectations of capital gain. So if you think house prices are going to rise in the future, then that effectively lowers your cost. And householders essentially try to equalize these two such that the rent on a given house is equal to the price times the user costs. So when you boil all that down, what does it mean in real terms? Well, it means that you can think of house prices as the discounted future stream of rents. So if you take the rent on a house and you divide it by the costs you face in terms of mortgage rates, tax and depreciation, you should broadly, if the housing market is in equilibrium, you should be able to infer the house price from that equation. So what is that? That's some quite important implications. One is that we can see from that housing supply only has its effect on house prices through its effect on rents. So if you have more stock, then you'll lower the market rent, and through lowering the rent, you will lower prices. Secondly, the house prices are driven by both the rent and that user cost of capital figure. effectively the mortgage rate primarily, but also taxes and depreciation, which obviously tend to change less over time. So when we, and what that means really is that when we see house prices changing, we have to be thinking about both sides of that, or both parts of that ratio. We have to be thinking about that. Has the rent changed, which is your indicator of supply, and has the user cost in some way changed? And that's where these two prices, the price of housing services and the price of housing assets, that's how they are related. And then thirdly, as I mentioned before, the third implication is that the rent in the open market tends to be equal to the cost of owning a house when the housing market is in equilibrium. So whether you own it outright, if you're an outright homeowner, then the foregone income on the capital locked up in your house should, plus the depreciation and tax, should be equal to the rent that you would pay on renting that house. So in other words, there's no free lunches. There's no sense in which one tenure should be cheaper than another in normal times. These two day-to-day costs are tied together, and there's no sort of escaping that. So if we take that equation, simplified version of where the house prices come from, how they defined or how they derived. We can think about, well, okay, let's look at that ratio and think about what's happened. Well, as I sort of showed just before, rents in the UK have risen something like 20% in real terms since 1996. Now that's a lot slower than average incomes have grown. But that doesn't really help us much in terms of the 160% increase in real house prices over that long period. So we're really going to be looking more at the denominator here, the mortgage rate, taxes and depreciation. And taxes and depreciation haven't really changed a lot in the UK. They're broadly pretty stable. You might think they're about 1 to 1.5% of the value of a house on average. And that hasn't really changed, but interest rates and the mortgage rate, this has moved a lot, as anybody who has owned a house over recent decades will know. And when that changes, you can see instantly what impact this has via a stable level of rent onto house prices. So just the picture there to reinforce that point about global interest rates, this is the picture we're really looking at. This is 10-year index gilts for the UK. And these obviously anchor interest rates across the economy, and particularly mortgage rates. And we can see that risk-free rate has fallen steadily from the late 1990s. Around here, the Asian financial crisis in the late 90s is the first point at which this starts to drop quickly. And then what you see is a steady trend downwards, and then after the financial crisis, a further lurch downwards, and indeed from the current coronavirus crisis, further the risk-free rate plummeting, further debts. Now that inevitably has an impact on mortgage rates, and therefore inevitably has an impact on house prices. And you can put this all together into a model that can effectively simulate all these elements, taking what's happened to rent, taking what's happened to the risk-free rate, and the other components of what theory says should determine prices, and see how well it fits the data. And this is an exercise that the Bank of England undertook, published last year, some research at the bank, looking at England and Wales house prices, their actual prices versus modelled house prices. And what you can see, first of all, there is the first two bits of, sorry, I should say this is an index. So this is the 0 is prices at the start of the period in 2000. And we're going to see how it changes up to 2018. And you can see here that rent and rent expectations, this is the key indicator of whether supply has had some kind of effect, is basically had no impact on prices at all there. Meanwhile, there's increases just in respect of inflation, as you'd expect. and then the increase in prices driven by the falling risk-free rate pushing up house prices for a given level of rent. You can see there in the blue. Now, let me put the other lines on. Now, the yellow line here is the sort of the house price chart line that we've actually seen in the UK, and you can kind of see that in the mid 2000s you had this pretty obvious bubble where house prices are way above what the fundamentals suggested they should be. But really, since the financial crisis, there's been quite a close match between the modelled number and the actual house prices, as interest rates fell further, supporting what were already very high house prices. So over the period as a whole, this kind of theory can't tell you much about what's going to happen to house prices next year, but it can tell you over long periods what drives them, what's the tide on which these prices move. And it pretty clearly corroborates the idea that overwhelmingly house prices have been driven in the UK for the past 20 years by this falling interest rate phenomenon. And the impact through rents has been negligible. And you get similar stories for the UK as well as the EU. Another set of researchers at the bank came to a similar conclusion at the end of last year, showing that house price to income ratios over a longer time period here of 35 years or so, almost 35 years, can be more than accounted for by the decline in the risk-free rate. Cameron's paper for Australia shows a similar impact, as does a recent one from the Reserve Bank. And finally, that model I just showed you from Cumming and Lewis at the Bank of England comes to a similar conclusion. So a growing body of evidence that the story is reasonably clear about what's happened and why it's happened in UK housing, but also in Australia as well. Now, some people take this analysis of what's happened in the past as a suggestion that supply has no impact on house prices. Now, that's obviously not true. As I sort of set out there, housing supply, if you build more houses faster than the population or the number of households is growing, you will inevitably bear down on rents, and by pushing down rents, you push down prices, and you'd expect that to be a one-for-one relationship. So, how much could supply help if we were to ramp up the rate of building? Well, here's a selection of some of the studies that are regularly drawn upon that look at the responsiveness of house prices, or you can derive from them the responsiveness of house prices to additional supply, and the way these things are usually developed. The way the supply is measured is kind of excess capacity. So that is surplus of dwellings over households. And if we increase you remember from the first chart, one of the first charts I showed you, in the UK, there's a surplus of about 5% more dwellings than there are households in the UK. And then most of these kind of models, the question is, well, if you were to increase that by 1 percentage point, what impact would you expect that to have on prices and rents, all else equal? And so you can see in most of these numbers are between 1 and 2. So a 1 percentage point increase in the surplus stock of housing you might expect to reduce prices by between 1 and 2% over time. So we can use that to sort of calculate very rough and ready figures for what extra supply what impact extra supply might have. And in the UK, the government's goal is to build 300,000 additional houses per year in England in order to tackle what they see as this supply shortage. So if we assume that households, around 200,000 households form a year, that's slightly above the recent historical norm. But for simplicity, 200,000 houses a year form. 300,000 houses a year are built. Well, what would happen to prices and rents under that situation if we did it for 20 years? the current 23 million households today would rise to about 27 million by 2039. The number of houses would rise from 24 million to 30 million, and the surplus stock would grow from about 5.2 to about 11.8% in 20 years' time. So if we just apply a kind of middle of the pack estimate of the sensitivity here, that would reduce prices and rents by about 12% in real terms over 20 years. Now that's not nothing, and it's not necessarily to be sniffed at. It's a significant scale of impact, but it's pretty small in comparison with the 160% increase in real terms prices we've seen since 1996. So it's not really much of a solution to the housing crisis if you define it in terms of house prices. The sensitivity simply isn't high enough. The kind of scale of additions wouldn't be fast enough to have any real impact anytime soon, and it certainly wouldn't be able to reverse the price growth of recent years. And that's before we get on to any questions about whether it's economically wise to add that much vacant housing stock into a country. So you can do this kind of back of the fag packet calculation in any country, but it's these responsiveness figures that really drive the result and tend to show that supply isn't really a particularly useful lever for affordability. Okay, and then finally, I'll just turn to talk briefly about falling home ownership. Now, this is probably more of a story in the UK than it is in Australia, although I think home ownership in Australia has been drifting down a bit over the last couple of census periods. But it does show, I think, how the various different bits of the story and the role of the mortgage market come into play in a way that's kind of complementary to the story I've just been telling. In the UK, it's quite a major feature of the political debate and the definition of the housing crisis, and it gives extra power to claims that there's a shortage of housing stock and that building more will solve this problem as well as the house price problem, which some people see as linked. And you can see here that home ownership peaked in the sort of early 2000s and started a sort of downward trend, and then at the time of the financial crisis, it really tanked substantially and ended up at levels of home ownership down at just below 63%. I think it was that we haven't seen for many decades in the UK. So it's really been quite a profound social change, with lots of families with children now in the private rented sector, and many more than was normal in the past, and older people as well. So this is quite a big shift. But we can look before and after the financial crisis and just split. So this is split regions up and take a look at, well, what happened to house prices in these two periods and what happened to the home ownership rate in these two periods. So in the red bubble, you've got English regions, and you've got the change in house prices on the x-axis. So you can see in that red bubble, house prices grew pretty rapidly between 2001 and 2007 across all of those regions. But home ownership was pretty stable. In some areas it increased, in most areas it fell a little bit. But then in the post-crisis era, you have a very different picture. House prices were broadly stable on average. They fell in some places between 2007 and 2016. They grew in other places, but home ownership dropped very substantially in every single one of those areas over the period. So at a time when prices were stable, home ownership collapsed, and when prices were rocketing ahead, home ownership was pretty stable. So this doesn't really look like a particularly strong evidence for the role of prices in determining home ownership. And in fact, when we look at what happens simply to, obviously, most first-time buyers are buying with a mortgage. Very few can afford not to do that. And so we can simply look at what happened to new first-time buyer mortgage issuance over the period. And what you see is in the run-up to the financial crisis, there was a steady between 350,000 and 400,000 first-time buyer loans being issued every year, and that overnight essentially collapsed in 2008 during the financial crisis, and it halved pretty much overnight and took a number of years to recover, and that simply slowed the movement of first-time buyers, perhaps 1 million or so, into home ownership, which is the simplest and most obvious explanation for why that home ownership continued to fall. So prices have an impact on the home ownership rates, that's true, but it's relatively weak. And the single biggest cause was that banks simply stopped lending to first-time buyers unless they had very large deposits. And I think we saw similar trends in other places as well. I think a similar story holds for the US over the period as well. And that has some important implications if we want to raise home ownership. It's for a variety of reasons, supply is not going to be the solution. A, because it doesn't have much impact on prices, but B, because prices don't have a huge amount of impact on home ownership rates. This is primarily a story about credit and who's willing to bear the risk of lending to first-time buyers. Okay, so just to conclude then quickly on the evidence. So both, I've taken through both rents and volumes, and they both indicate that a shortage of supply did not contribute to the UK's 160% real terms house price increase over the past 24 years or so. The idea of a housing shortage tends to rest on this view of house prices as an indicator of the demand for housing services, when in fact that's not the indicator. The real indicator is rents, and prices have risen relative to incomes, but also rents, mainly due to falling global interest rates, as well as some other financial currents, particularly overseas investment in major cities, which I know has been a story in Australia as well as London, and also domestic mortgage market liberalisation, particularly in the late 90s in the UK. There has been, one of the things that is sometimes confusing about this story is that it is also true there has been a decline in affordability for some renters, despite the fact that rents have been stable as a proportion of median incomes. And that is because there have been erosions of the social rented sector, and also benefit cuts, which tend to mean that people have come out of subsidised housing and had to move into market housing. But the key point for our purposes here is that the rental price of market housing has not deteriorated in terms of its affordability. In fact, it's on average, it's improved. And none of this is to say that we don't need to build any more houses. It's fairly obvious that to maintain affordability where it is, you need to housing supply, or new housing supply, to keep pace with the rate of household formation. But the key point is that thinking of housing supply as a tool for shifting prices is the wrong, I think, the wrong way to think about it. There's no plausible rate of supply that would significantly change the deterioration in house price affordability that we've seen over the past 20 years. And then finally, the primary cause of collapsing home ownership was the withdrawal of credit from first-time buyers following the financial crisis, and that obviously has further implications today in the coronavirus crisis. Certainly in the early phases of that, we saw further withdrawal of credit from first-time buyers, which threatens a further reduction in home ownership, and we'll have to keep an eye on that to see how that develops. And so, in a sense, I started by saying there were perhaps 4 definitions of the housing crisis, or 4 prongs to it, and that most people thought that they had one cause in terms of supply. But really, they have all these different causes, and it's something of a coincidence they all come at the same time. So in terms of unaffordable housing costs, in terms of rents, and levels of homelessness. These are about distributional policy. These are about benefits, social housing, and the policies in place to deal with those things, but also to some extent about macroeconomic performance. The fall in home ownership is primarily about mortgage lending and capital requirements for first-time buyers. Those are the tools that you have to direct credit towards first-time buyers. And then unaffordable house prices are primarily this function of low global interest rates and foreign investment. So different aspects of the housing crisis, these different symptoms, have different causes, and supply is not really a meaningful solution to any of them. And then I thought I'd leave you just to provoke some discussion, some quick implications, and these there are many others which I didn't get a chance to write down, but some just to get us started. One of the takeaways from this is that there's no use pretending that supply is a significant determinant of prices or a solution to the other aspects of the crisis. What flows from that is we need to decide how much we care, whether we care about house prices. As long as rents are under control and the day-to-day cost of housing is under control, do we care about the level of prices enough to do something material to reduce them? There are things we could do, constraints on mortgage lending and all sorts of things, but is there the political will to do that? And do we care enough to do it? I don't know. And then how do we feel about the fact, how do politicians explain to people? It's easy to explain a story which says, a lack of supply, we're going to build more, then everything will become more affordable. But if we lose that story, then how do we feel about trying to explain, or politicians trying to explain to people that really house prices and their affordability, the affordability of buying a house is affected by these forces well beyond their control of global interest rates that can redistribute wealth from asset holders, from people who want to buy a house in the future to people who currently hold those houses. That kind of arbitrary redistribution of wealth between people is obviously politically very controversial and difficult to explain. So how do we feel about that? And also we need to decide whether we care about higher home ownership and whether we're prepared to do the things that might increase it, or whether we just want to focus on things like security of tenure and those kind of questions for people who are in the private rented sector, to make sure that there isn't such a gap in the experience between different tenure types. And that's a big topic of debate in the UK. But again, if we do want to shift home ownership, we have to be honest about what it would take to do that. And then finally, housing affordability is overwhelmingly a distributional question. It's about who has which bit of the pie. It can't really be solved in aggregate through greater supply any more than you might think that relative poverty can be solved by faster GDP growth. Ultimately, it's about who gets what. And once we look at housing policy through that lens, a lot of the focus of purported solutions that we've heard over the last recent decades kind of falls away, and we could have a more honest debate about how we tackle some of these things. Okay, I'll leave it there. Thank you.
Thanks very much, Ian. That was very interesting. Yeah, look, just to help us with the Q&A, I've invited Cameron Murray, who's a research fellow with the Trust and also one of Australia's leading housing economists, to interrupt his holiday and just join us. And if you could just turn on your video there, Cameron. Yeah.
Can you see me?
Yeah, we can see you fine. Yeah, thanks for jumping in. Maybe if you could just perhaps provide a few initial comments, and then we'll switch to Q&A. And I might go to you, Cameron, if there's a very Australian question, and I'll direct the more general questions to Ian. So just like to make a quick response.
Yeah, great. Well, thanks very much for all that, Ian. I think it's really nice to look at these types of issues from an outsider's perspective. And I suspect much of the audience hasn't really been up close and personal with the UK debate. So it's nice to see it presented that way and be able to judge it without the emotional attachment to it. And I think that's also symptomatic that the problem of the detachment of prices from rents the price of the housing asset from the house of the price for the service is a global phenomenon. And one of the stats that I now often share with people who haven't really dug into the supply side is that since 2012, the prices in Houston, Texas, the city that many hold up as the deregulated, no planning utopia, rose 60% since 2012, which is almost the same as Sydney, where prices went up 65%. So that detachment of prices from rents, it's not due to those local factors. And I think if we can lift our heads up a bit and look at the experience in the UK, look at major cities around the globe, we might actually start focusing on those common factors that sort of synchronized global monetary policy. I just want to also share one little story. Your asset pricing explanation, I thought was very good, that explaining that detachment of rents from prices via the interest rate and tax rates, etc. Now, in 2015, the Reserve Bank of Australia released a research paper doing that same exercise for Australia. And they had borrowed from that Bank of England paper that I think you mentioned. And the analysis there said prices in Sydney were undervalued by around 30% in 2015. And this is in the middle of this boom and everyone's thinking, prices are out of reach for everybody. And what happened in the next 4 years? Prices rose 30% exactly. So I think you're spot on that we need to be thinking about the price as the asset price, and that leads directly to your conclusions about what do we care about for policy. And maybe people have some questions about that. Like, does it matter if prices are $1 million if rents are 15 or 20,000 a year? Occupying a house is not $1 million, but the asset purchases, right? So I thoroughly enjoyed it, and that's my response. And it's sort of amazing to see how close the parallels have been, the debates around supply in the UK and Australia and many other places that I've actually looked into. So thanks again, Ian, and let's have a great discussion.
Thanks, Cameron, for those remarks. I've got a couple of questions which I think I'll just push straight to you, Ian. One is from David C, and he makes the comment that as your think tank represents the Tony Blair Institute, are you not trying to justify the low levels of house building during Tony Blair's tenure, which coincided with skyrocketing house prices? Why shouldn't we think you're biased?
Oh, good question. Well, a couple of things on that. I mean, I think the first thing is I've been talking about this and writing about this for a number of years, well before I joined TBI. So you can see some of the historical stuff on that, and I've been saying the same thing for a while. I think there is an interesting point though about the Blair government's record on it, because I don't think, as I say, I think the driver of house prices has been this, global interest rate story, which really, at least given where the UK housing market was and the deregulated mortgage finance market, the last measures of which were taken in sort of 1996, where the Labour government came in 1997. There wasn't a huge amount, unless they were going to re-regulate, that they could have done to put a lid on prices, which goes to my point about how much do we really care about prices. But I think there was a sense in certainly on the left and the right for at least 25 years until recently, perhaps. I think there's been a pretty strong consensus that supply is the story. Which I think does mean that governments of all types have been sort of looking the wrong way on this, and thinking that in some ways beating themselves up about supply when that isn't really where the action is. So I think there is, and it's interesting to see. I mean, I know I think. Last year, he had Josh Ryan Collins, and he speaking, and he gave a similar kind of account of the role of mortgage finance. And it's interesting that many people on the left in the UK are now starting to see things in a slightly different way, and that maybe past governments should have considered the role of interest rates and credit in this story more than they did. So that is true, but I think it's pretty clear that certainly, if anything, it was a sin of omission, not of commission.
Thanks for that, Ian. Look, we've got another one for you, Ian. And this is from Steve Aleppo, who said, Ian, you haven't mentioned Help to Buy, which I guess is a government program, you might explain, stamp duty holidays, and the growing market share of volume house building and deliberately slow build-out rates. What impacts do you think these features have had on the UK housing scene?
Yeah, really good question. So Help to Buy in the UK was, and this is a policy that was introduced by the Conservative government in the wake of the financial crisis, and it was introduced because of that collapsing home ownership line that I showed you. The government was looking at essentially a complete drought of lending to first-time buyers and lenders who were only prepared to lend to first-time buyers who had, say, 10%. A deposit, and so the government stepped in with a whole suite of packages essentially aimed at guaranteeing bits of the mortgage loan and those sorts of things in order to get credit flowing to first-time buyers again and put a floor under home ownership. And so that was really the aim of that. Now, lots of people said, well, isn't this just stoking up demand? It's going to push up house prices even further. But I sort of feel like that's a bit wide of the mark, in the sense that what we saw after 2008 was just a redirection of credit towards people who had some equity and away from those that didn't. So it wasn't that and so these government schemes are in a sense rebalancing the ability of first-time buyers to buy and get on the housing ladder. I think most studies that have looked into it suggest that it had a pretty negligible impact on prices, sort of less than 1% kind of impact on prices. So I don't think we can really blame that for a significant increase in cost, but it does go to the heart of the problem of what are we prepared to do to get home ownership to be higher, either in the UK or anywhere else. Like, are we prepared for taxpayers to take on the risk of lending to first-time buyers in order to get banks to lend to them more, or not? Is that something we should avoid or not? I mean, it's not clear to me what the answers to that question are. In terms of other things, obviously we've had, in the wake of the coronavirus crisis, we've had a stamp duty cut here in the UK, which has pepped up the UK housing market, which is probably not all that advisable. But these things happen, and obviously largely done for sort of macroeconomic reasons rather than anything to do with the housing market. But I think we'll see any of those gains given back once stamp duty gets reimposed early next year. I can't remember what a couple of the other things that were mentioned there were, Peter. Can you
deliberately slow build-out rates of increasingly the growing market share of volume house builders. Do you think that's had an impact?
And a lot's been made of the growing market share of house builders. I mean, I'm no competition economist, so I'm not an expert in this, but I don't particularly see the concentration as obviously a problem in the UK. Obviously, different developers have concentration of their sort of activities in certain parts of the country, so maybe it's more concentrated than it looks at a national level. But it's not hugely different from many other markets you'd see in terms of the concentration of the main players. I think in terms of the build out rate, there's a much more compelling, and Cameron's done a lot of work on this in Australia, but there are many more compelling explanations for why house builders don't build out quicker, mainly to do with the absorption rate and how quickly people are prepared to buy from them. They don't want to build and have these things sitting empty. And also, I think the critical thing is, if you've got a house builder that has 20% of the market in the UK, even if we're building 1% more houses, 1% additional stock each year, then this developer is going to be responsible for 0.2%. Now, even if it dumps its entire 0.2% of new supply on the market on one day, you're not really going to expect the equilibrium prices to change by much more than, 0.3, 0.4%. So to my mind, it's a bit fanciful to imagine that even the biggest players can materially shift prices, equilibrium prices, by building out quicker. They really can't. They're price takers. They're playing into a market where there's already, almost 25 million units. They're a drop in the ocean. So the idea that they can tank prices, and that's why they slow the build out rate, to me just doesn't really stack up.
Yeah, no, thanks for that, Ian. I might give you this next one, Cameron, because I think it's more in the Australian context, and it's from David Tenevsky. And David's saying, I'll ask you this question: assuming rates are constant, so interest rates are constant for the next 5 years, and if the planning system is slow and not responsive to demand for a home in a particular location, and it takes 2 to 3 years to supply that demand, wouldn't that have an upward pressure on house prices? So what would your response to that be, Cameron?
Can everyone hear me all right? I think, look, I don't think it's going to have much difference. I think if we take the evidence seriously that Ian's put together here, that those supply, even if it's delayed a couple of years, is only going to be a small change to the total stock in a region. You've got to remember that the total stock of dwellings only changes 1 to 2% per year. And yet all of those are rented in that rental market. So even if that 1 or 2% was delayed 1 or 2 years, that price effect is going to be very marginal. In just somewhat explained the scope. It would only be a few percent difference, and that would correct, obviously, if there's a lag. But I think it's also important, if you're thinking about lags in the planning system and its effect on supply, you can't just compare two periods and go, oh, people want to build today and it takes 2 years and then they're building then, therefore there was no supply. Because every intermediate period between, there was someone who before you tried to get their building built. And so you can't think about, oh, well, it takes a long time. Well, it takes a long time to build a 747 as well, right? But we plan in advance for these things. And different providers of airlines build at different rates. So I think that's another thing to keep in mind. If we take it seriously, a couple of years delay in supply is not having a major effect on price. And I think also delays to the supply of individual houses are not equivalent to a delay in the rate of new supply per period, because people plan at all time periods and supply is continuous.
Okay, yeah, thanks very much for that, Cameron. Look, we've got some other excellent questions in chat, but I might take the liberty of just passing those on to Ian and Cameron and see if they've got time to reply to people individually, because we really are pretty short on time, and I want to make sure we finish on time tonight so you can get on with your evening. So look, can we just all put our virtual hands together and thank Ian very much for getting up early. And Ian, you should thank your daughter for abandoning her bedroom early. She'll get a special Festival Urbanism Award. We'll talk about that offline.
Thank you, Peter.
Might make her an honorary London festival goer on behalf of the Henry Halloran Trust. But thanks very much for your lecture. It was very interesting. We'll put your slides up online. The recordings will be up next week, and we'll probably post your paper that you mentioned in your introduction as well.
Thanks, Peter. It's been great talking to you.
Good luck with the rest of your day, and appreciate your help. And thanks, Cameron, for interrupting your holiday and providing those excellent comments. You can return to your evening in Queensland. Okay, look, just a little bit of housekeeping. Thanks, guys. A little bit of housekeeping. We've been posting some material up from all the events on the Trust there on the Festival Urbanism website at festivalurbanism.com. We're going to give the recordings that we've made over the last 2 weeks a light edit. We'll post those up towards the end of next week. I'll send a message around to everyone who's registered when they're available, and you can have a look at them in your leisure. I think we've had an excellent festival, lots of really interesting talks, and I really commend all the presenters and the moderators for their help over the 2 weeks. I'm just about to sign off from the Festival Urbanism studio, but before that, I'd like to thank some people. A big shout out to the people behind the scenes here. First to Kim Beecroft, who is in charge of marketing, did an excellent job. We have Lillian Torresan, who's been in charge of catering, quality control, and just about everything else. We've had Andrew Aiello, who has been our Zoom operator, and a special shout out to Sam from Inner West Media, who's been our camera operator, ATM operator, and audio person for the festival. Thanks very much for all your help, everyone. But special thank you for all the festival goers. Really appreciated your interest. Fantastic questions in chat. And just the last thing I'll mention, that we're going to put all our talks together in a festival monograph. It'll be coming out early December. And again, we'll let people know about that. You'll be able to download that from the website as well. So thanks very much for joining. Hope to see you next year. Even though I won't be in the chair, I'll have someone else in the chair next year at the next Festival of Urbanism. And Henry Halloran Trust really thanks you for your interest, and have a lovely evening and a good rest of the year. Thank you very much.